This is a presentation about the corporate income statement and the two classifications found there, continuing operations and discontinued operations. Both of these classifications are shown on an after-tax basis on our income statement. The continuing operations are those activities that are expected to continue and generate revenue into the future, that is, into the next accounting period, whereas discontinued activities are those revenue-generating activities that we stopped or terminated during the current period. If we want to predict our future results, we want to look at only those activities that are actually going to carry forward when we do those revenue projections. To understand the nature of discontinued activities, let's look at a little example. If we have a business that has two different income streams, two different sources of revenue, one being retailing operations and the other being a television station, if either one of those were to be terminated, that would be considered a discontinued operation. So on the example income statement, on the left-hand side we see all our traditional income statement accounts: sales, cost of goods sold, operating expenses, other revenues and expenses, to arrive at an income before tax. Notice the last line on the left side is income from continuing operations before tax. On the other side we have our discontinued. If we were to discontinue our television activities, then we would sell off the assets that we use to generate the revenue. So this would be the sale of the station, its equipment, its furniture, and so forth. And in selling off those assets, we have a gain that has resulted from that discontinued activity of $50,000 in this example. In addition to that, we also have the income and expense accounts to consider. Last year, our sales account would have been sales from both retailing and television. This year, our sales account is from the retailing only, since that's the only continuing operation. Here, under income or loss from discontinued operations, we would take all of the television station revenues minus the television station expenses, and we can see that this year, in the year of termination, it's resulted in a loss of $12,000. Now, we have to consider the tax effect of these items on our income statement. For net gains, we would record an income tax expense. For losses, an income tax reduction. When we look at our income statement, how many tax items would have to appear on this income statement? Well, on the left side, our income from continuing operations would have to have tax deducted, but so would each of the individual items reported under discontinued. So that means that in total then, we would have tax items appearing 3 times on this income statement. Under continuing operations and under each of the discontinued. To calculate the amount of tax expense, multiply the before tax gain or loss by the tax rate. So on our income from continuing operations, which is $30,000, $30,000 times our tax rate of 40% means our tax expense would be $12,000, giving us an after-tax amount of $18,000 income from continuing operations. For our discontinued, we have our gain of 50 times 40% means tax expense of $20,000 and an after-tax gain of 30, and for our loss from discontinued operations times 40% means a tax reduction of $4,800, giving us an after-tax loss of $7,200. Notice we are deducting the tax reduction to come up with the after-tax loss. Looking at how that would appear on the income statement, our first major classification is income from continuing operations. You can see that's on an after-tax basis at $18,000. Our second classification is income from discontinued operations. Notice it's the sum of our two elements. The gain on sale on an after-tax base of 30, the loss from operations on an after-tax base of 7,200, the net of those two, an overall increase in income of 22,800, combined with our income from continuing 18,000 to give us our net income of 40,800. Now, to complete our statement, we need to add our earnings per share. This would come right after the net income on the income statement. And to see how this would look, we have to know the weighted average number of common shares outstanding. Assuming that was 10,000, we'd report earnings per share and income from continuing, taking the $18,000, dividing by 10,000, giving us $1.80 per share. From discontinued, the 22,800 divided by 10,000, or $2.28, and for the net income, the 40,800 divided by 10,000, giving us $4.08 per share. So these earnings per share calculations would follow right after the income statement on our financial statement. This concludes our review of the income statement.